We're going to start in with the Chapter 4 slides, and as I said, the quiz questions, several of them are embedded in the Chapter 4 um, file, and so you'll see them in there as we go through. And I have to remember when I'm in slideshow, I think if I unclick all of these things, it stops that annoying thing where where it keeps wanting to advance the slide every time I write on it, so hopefully that'll stop. Okay, all right, so let's just go ahead now, and the main discussion here is going to be income statement and comprehensive income, which we've actually already started the discussion of comprehensive income in Chapter 3, but we're going to get a little more detailed here in Chapter 4. Again, I've adapted these slides, but Ben was good enough to let me start with his, and I'm going to have to at some point remember to put the right class here. This is Business 121. 121A. Okay. All right. So we'll go ahead and. Oh, now, what is this? Okay. So let's go ahead and let's talk about earnings. And when we talk about quality of earnings, there really are two components that a company thinks about. One is going to be the persistence of earnings. Okay. So it's one thing to report our net income for 1 year, but how is that going to continue into the future would be a consideration of the consistency or persistence portion, I should say, of the quality of earnings. Okay. The other part is can we develop expectations about past current period performance? And remember, when we looked at our conceptual framework, we said that accounting information should have what? Should have both predictive value and feedback value as well as being verifiable. Okay, so when we talk about the predicting of earnings and how that could run into the issue of earnings management. Okay, so what happens? Management can manage their earnings by what accounting methods they select or how they treat certain accounting methods. For example, a company could decide to take more in their allowance in a current year because maybe their net income is what? Looking pretty good in the current year. They take a little bit more bad debt expense, take a little bit more into the allowance so that in future years, if net income starts looking like it's not going to be as solid, they can turn around and do what? Say, oh, look, gee, we put too much in the allowance in previous years. We don't need as much this year, and take less in the allowance, thus managing their net income, right? Another thing that management could do is try to manipulate their earnings by what? Inventory methods they choose for using for carrying their inventory on their balance sheet. So they could do something where they go to, say, a LIFO based inventory. Maybe they were using FIFO, they go to LIFO based, and maybe they hold back production of inventory for a while, or they hold back purchases of inventory for a while and use up some of the more costly layers. And by the time you get down to some of those bottom layers of inventory, those are going to be reporting cost of goods sold at a lower cost, right? And all of a sudden they start showing larger income in those later years, trying to manage their earnings a little bit. So this is something that is difficult for auditors to sometimes get around because what? Well, you'd have to start saying, well, you changed your inventory method and you really didn't have any good reason to do that. It wasn't to improve your accounting data, it was to manage your earnings. And that gets to be a little bit of a more difficult issue to get into with management if you're an auditor. So there is that issue that management could potentially manage their earnings. So we want to look at the persistence of earnings, but we also have to be concerned that management might try to manage their earnings to a certain extent. Okay, so let's just take a look at, now that we've understood something about the quality of earnings, let's look at the way the income statement is going to be arranged, okay? And we're going to have revenues, we'll have gains, we're going to have losses, okay? Now, we've talked about this a little bit before in some of our earlier discussions, but revenue is what? Considered, and we talked about this a little bit last in another class, guys, is going to be normal course of business. Did we talk about this before? Right? Revenues are normal course of business, and we're going to report that gross. Okay, so we'll report whatever our revenues are gross. Expenses are also going to be what? Normal course of business. Okay, we're going to report those gross. So both of these are reported on the balance sheet gross. You could also say, well, you could just say they're reported gross, period. Okay, now revenue for a, I don't know, hair salon is shampooing revenue, whatever, hair cutting revenue, whatever, right? Okay. Expenses would be the salaries we have to pay the beauticians or whatever, right? Okay, normal course of business. Now you come over and you have gains and losses. Did everybody sign in? Okay, you have gains and losses. Now when you look at gains and losses, those are going to be contrasted with revenues and expenses, and that they are what? Not normal course of business. Okay, so these are going to be things that are peripheral, incidental transactions. That's what we mean by not normal course of business. Okay, and these are reported what? Net, we said last time. They're reported net. So what happens? You're Nordstrom, and you sell your cash registers. Is Nordstrom in the business of selling cash registers? They are not. So what happens? They sell them, and they sell them for more than their book value. They'll report those as gains in the non-operating section of their financial report. So maybe we can put that next to revenue and expenses. You can put operating items. And guys, if you didn't bring the slide, it's going to start that. If you didn't bring the slides, because I put them up kind of late, I'll put this marked up version up so you can kind of see some of the things I wrote in on the slides. If somebody reminds me to do it at the end of class here, say, can you post those up and I'll do it? Otherwise, I'll click on save it and I won't keep these, and then you won't have it. So somebody remind me, okay, so that I remember to save this and put it up. So our revenue and expenses are what? Operating items. Our gains and losses are going to be non-operating because they are peripheral to the ongoing central operations of this entity, so we call them non-operating. So when Nordstrom sells their cash registers, what happens? They are not in the business of selling cash registers, but they may sell them because they want to get a whole new set of cash registers or something, right? So when they report that, they'll report that in the non-operating section of the income statement. They'll report those as gains. But when we say that they report them net, we say we report them net, let's say they had to pay a projector dealer some amount to take the projectors off their hands, a commission or something like that. They would literally, did I say projector dealer? Sorry, in another class it's a projector. Some classes I use projectors as examples because there's projectors in the class. They sell them to a cash register dealer. Okay, when they sell them to a cash register dealer, they charge them a commission. Well, they would back off that commission that they have to pay and report that gain net of those commissions. Okay, losses are what? Not the normal course of business. I don't know. Let's say somebody vandalizes all the mannequins in Nordstrom or something, right? And they sit there and they say, oh geez, now we have to buy a whole bunch of new mannequins or whatever, right? Well, they're not in the business. It's because it's the vandalism, because they are in the business as part of their expenses to have mannequins. But if it's a vandalism thing, okay, then they would report that as a loss. And if they had some insurance coverage for vandalism, then what? Then they would go ahead and report that net of any insurance recoveries that they had. Okay? All right, good. So revenues, expenses, gains, and losses. Now, what we have here is something called the single step income statement. Single step income statement, basically groups all of the revenues together and all the expenses together in the derivation of net income. Okay, so when you look, they really take all the pluses together, and then they take what? All the minuses together, and they calculate the net income like this in the single step income statement. They globbed all the pluses, all the minuses together. For example, dividend revenue would potentially be a non-operating item if I'm not a bank investing in stocks on a regular basis and that, but I have some investments and it generates dividend revenue. If I was going to group this into the operating, non-operating format that we'll look at in a minute, these dividend revenue would be down in the non-operating, right? But in the single step, since it's increasing my net income, I put it with the revenues. Anything that decreases net income, I put down here with the expenses, and the difference is revenue minus expenses gives me net income. They call that single step, and I kind of look at that and I'm always, well, why did they call it single step? They should have called it the two-step. Revenues, expenses. But then I guess the country western people would have gotten mad at them if they called it two-step, so they decided to call it single step. Never mind. There's a country western. It's called a two-step. Okay, let me take that one out of my repertoire. Okay, of jokes. All right. So that's how they derive the net income. Okay. Now you come over and you look at this multiple step income statement. And this is where we're going to spend most of our time talking about the format of the income statement. So you come down from sales, and notice you have cost of sales, you have your gross profit, your selling and administrative expenses, etc. And you come all the way down to income from operations. These are all operating items. So we have all of our operating items here. Then we come down and we start having things that we end up with our income from operations. Then we come down and we start having these other items, like this interest expense. They're considering non-operating. And then we have basically this little section here, which we call tax. Okay? So when you look at your income from continuing operations, it really has these three categories here, which are going to be our operating section, our non-operating section, and then we show tax. So three sections: operating, non-operating, and then tax. Okay? Now, we're going to get into a little bit later that a company could shut down a part of its operations. It decides to get rid of a segment of its operations or whatever, usually because they're not profitable. And they will separate that from their continuing operations. They'll call that discontinued operations, and then we have net income. Now, if you don't have discontinued operations, then you don't have to call this income from continuing operations. You'll just call this net income. Question? Income tax is just tax. Income before income tax would be operating. I mean, it's operating. Okay, but basically, I'm more interested in the elements up here that constitute operating. I mean, this is just sort of a subtotal, if you will. Income before income tax. Just know that tax is then its separate section, and then you have income from continuing operations. But the takeaway, let me say it more clearly, is that income from continuing operations consists of operating, non-operating, and tax. Let me say it again. Income from continuing operations has three elements, which is what? Operating items, non-operating items, and tax. Okay? And the reason we're calling out income from continuing operations here is companies, they don't always have it. They don't have it that much. But companies could potentially have what? have a discontinued operation, and we'll talk more about this in a couple of minutes. They decide to dispose of a segment of their business. Well, FASB requires that we separate that from everything else, the continuing operations essentially, because that's going away, or maybe will be gone next year, or maybe have been gone by the end of this year, right? And so users of the financial reports want to see that part of the business separately, because what? It ain't going to be here anymore, right? So we separate that out, and then we calculate our net income. Now, if a company doesn't have a discontinued operation, fine. Then it's what? Everything that happened that year is all income from continuing operations, but we'll just call it net income because there is no discontinued operation to distinguish it from. Yes, sir. That is not separately disclosed. Yeah, it's not separately disclosed. When I say not separately disclosed, not in terms of the format of the financial reports, we might put something in the notes. But a discontinued operation, we separate off so that users of the financial statements will know that, hey, that part of the business is going away. Okay? So you've got what? Income from continuing operations, which is my operating, my non-operating, minus my tax, essentially, right? But I have a tax section there where I call out the tax. That gives me my income from continuing operations, and I'll call it out as such if I'm going to keep going and talk about what? A discontinued operation that I could potentially have. If I don't have it, then I would do away with the phrase income from continuing operations and just call it what? Net income. Okay? All right, good. Now you come over and you see that format. And then on this slide, notice we have our income from what? Continuing operations, and then what? Discontinued. Now, you could also have an accounting principle change that I want to put on here, not on IS, but would adjust beginning balance of what's RE? Retained earnings. So when we get to an accounting principle change, we're going to see here, I hope we get to it today. If not, we'll just talk about it as we finish up this chapter 4 slides. Towards the end of the chapter 4 slides, we are going to talk about how that is going to be an adjustment to the beginning balance of our retained earnings. And it's because we've changed some principle, and FASB, GAAP, requires that we adjust our beginning retained earnings to show what the effect of that change was on retained earnings, and we don't roll it through the income statement. So change in accounting principle is not reported on the income statement. It's reported where? An adjustment to the beginning balance of retained earnings, which is on the statement of retained earnings. Okay, so let me put that on statement of retained earnings. So it goes straight to the statement of retained earnings. Hello? Right, goes straight to the statement of retained earnings. It's an adjust the beginning balance. These two we know are reported on the income statement. We just saw it, right? Income from continuing operations and the discontinued operations. With me so far? Okay. Now, you say, well, what's this intra-period tax allocation all about? Well, notice when we had income from continuing operations, part of that was the tax. And so we show what tax is attributable to our income from continuing operations. Okay. But then we are required to go ahead, and when we report the discontinued operations, we are required to back out the tax effects of those items. And when we report them over here, we will report them net of tax. Since our net income is what? After tax, isn't it? Net income is after tax. They have us make a side calculation of the tax effects of the discontinued operation items. And then we do what? We bring them over net of tax so that everything we end up in our net income is what? Eventually reported after tax, isn't it? So we have to do that side calculation where we back out the tax effects. So that's what they mean by intra-period tax allocation. Some of our tax effect is what? Shown explicitly, the tax that's attributed to what? continuing operations. Then we do what? We do this side calculation on our discontinued operation items and report them what? Net of the tax effect. Okay? And then on that slide, we also had what? We also had the change in accounting principle, because what we do is when we make an adjustment to the beginning balance of retained earnings, we make that adjustment net of tax, because retained earnings is what? After we paid our tax, isn't it? We have our retained earnings, but that's after we backed out the tax effect. So an intra-period tax allocation does what? Allocates it between the operating items in which we see the tax explicitly. Then what? Then our non-operating, in which we're going to go ahead and do this side calculation. Notice they have the less the applicable tax effects, and then we report that what? Net of tax, whatever it is. And then when we make the adjustment to the beginning retained earnings, that is also net of tax. So we allocate the tax between those three components. Question? Okay, we're going to practice with some of this discontinued operations stuff here pretty quickly. All right. Okay, good. Now, when we look at our income statement, we have the operating section, we have the non-operating section, and then we have what? The tax. These all constitute the what? Income from continuing operations. I'm going to try to write it in continuing ops. It's going to let me do it. Am I going to make it all the way through? Okay, continuing ops. Okay. Okay, good. Then what? Then we go ahead and we let's take a look, and we have our discontinued operations section. Okay. And then remember last time I made that mistake where I subtracted the non-controlling interest off the balance sheet, and I said, oops, I meant to do that for the income statement. Okay, because we do what? We show our net income gross, and then we back out the non-controlling, the minority interest portion. So that can also show on the income statement. And then we are required to show earnings per share. Okay, and I'll show you a slide here a little bit later. It's easy calculation, earnings per share. You take your net income, you subtract your preferred dividends, your preferred stock dividends if you have any. You divide that by the number of shares outstanding, and that gives you your earnings per share. Very easy calculation, and we'll show that at the end. Okay? All right. Now, when we look at the income statement, we can classify our expenses, and we can classify them administrative, selling expenses, etc. FASB is fairly flexible in how companies display information on their financial reports. We're going to see that they're going to require us to call out things like discontinued operations. If there's something that's very unusual, we'll have to call that out, okay? But other than that, they're pretty flexible in how companies display information on their income statement. FASB is much more interested in what we're going to talk about in the next chapter, which is revenue recognition. Okay, look, how you display the information on your income statement, FASB is not going to get all up in their face, but what items qualify to be recorded as revenue, to even be put into the income statement to begin with, is more where they're spending more of their time. Okay, so you take a look in terms of telling us what to do anyway. And this is a multiple step income statement. So let's just go ahead and take a look at this, and I'm going to draw the line from sales, and I'm going to come all the way down to obviously income from operations, and these are no-brainer, guys. What? Operating items? Now when you look at this, notice they've got some what? Selling expenses, sales commissions, sales office salaries, shipping, delivery expense, shipping expenses, etc., right? Okay, these are all selling, administrative, officer salaries, office salaries, legal and professional services. How about accounting? How about accounting? Accounting is what? Is administrative, right? Is an administrative expense, okay? What happens if my office staff shares the same building as my factory. They're all in the same building. Is that going to be a selling expense, depreciation, whatever? Is it going to be a selling expense? Is it going to be part of my cost of goods sold? Is it an administrative expense? And the answer is what? Yes. It would be what? If they're all in the same building, it's all three, wouldn't it? And so we'd have to have some sort of allocation base, the type of things that you get into, what, in 122, where they have you do your cost and you step your cost down to your administrative department, your factory building, that sort of thing, and you allocate them accordingly. Okay? Okay, good. So we have our operating, and then we come down here and we have things like our dividend revenue, our rent revenue. Maybe we're renting part of our building or something. That's considered what? Non-operating. And then here's our interest too. Okay. And then we have income tax. That's what? That's obviously tax. And notice here, guys, they just came down and talked about net income without calling it income from continuing operations, because apparently this company didn't have a discontinued operation. So there's no sense in calling it income from continuing operations when there's nothing to distinguish it from, because there are no discontinued operations. So again, in that case, that bottom line is net income. And then, of course, we have to have the earnings per share stuff. Okay. Good. You could have a condensed income statement, just basically taking certain items and rolling them up accordingly. Okay, not providing all the detail. That's fine. You don't have to give all that detail. Under selling expenses, maybe in the footnote, whatever, you start calling all those other things out. And that's probably more the case of what you see. Company like, Apple, I think we looked at their financial reports. They're going to sit there and start calling out every single expense type that they have there. They just might call it administrative or something, right? And then they might give you a line item for something significant. For example, if you look at Tesla, Tesla's financial reports, they'll show these broad categories, but they do call out research and development as a significant expense. And when you look at that, you say, well, now I know why they had a net loss for the period, because all that money they're spending on research and development. Okay. All right, good. Oh, something important I forgot to point out to you. Where were we? Where's that? Where's that single step? See the single step? The net income was what? 164,489 was the net income. Okay? And then when we came over to this one, the multiple step, notice the net income was the same thing, 164,489. So the net income doesn't change because you decide to change the format. If you're using single step versus multiple step, you still get the same net income number, don't you? Okay. Even in the condensed version, it's not going to change the net income, obviously. Okay. Okay, good. Now you come over, and again, they are going to make us call out the discontinued operations. They're going to make us show as they subtract from the company-wide net income the non-controlling interest, right? But the real point of this slide is that FASB does want you to call out items that are considered unusual, okay? Things that don't happen very frequently in the company. There was something that was special about it. We don't do this every day, so it's unusual. If that's the case, this is one time where FASB gets up in our face and says, you will call that out separately on the income statement. They want the users to know about those particular things. So again, you look at this, FASB's format is fairly flexible, but they want you to call out what? Unusual items. They want you to call out the discontinued operations. We've already seen that. And they want you to subtract the minority interest or the non-controlling interest from your company-wide net income to calculate the to display the net income that's to the controlling interest, that's attributable to the controlling interest. Okay, so let's just take a look at some unusual items. Okay, losses on write-downs of receivable inventory. etc., could be unusual. You have a write down, and all of a sudden you haven't had those sort of write downs before. All of a sudden you have them. They'd like you to call that out separately. Restructuring change. The company does some sort of quasi reorganization or something, and there's some restructuring changes there. They want you to call that out. Gains on losses and sale of equipment. If that is considered strange, unusual, they want you to call that out, right? Okay. And then effects of a strike, etc. So again, this is not like an exhaustive list. This is an example of items that may rise to a level to be considered what? Unusual, and they want you to call those out separately. Okay? So restructuring changes is something that you might call out. That's not something that's done all the time. Okay? Now, let's just take a look at another example here of a multiple step income statement. And again, if you go from net sales all the way down to what? Right there. I'm not trying to draw Nebraska, guys. Okay, that's going to be, looks like one of the states. Is that Tennessee or Nebraska? Okay, so what happens? You come over here and you have this. This is what? Operating. Good. Then you have these other revenues, interest, etc., the expenses, interest expense, loss on the sale of fixed assets, income before unusual items. Okay. Now, the reason I'm pointing this out, they are calling out this loss on available for sale securities as a unusual item, aren't they? Okay, so see how it's giving it that particular line item. But all of these things are what? Non-operating. Good. And then you have what? Then you have tax. Okay, so the takeaway from this slide, I probably should have started with that, is notice how they have called this out as an unusual item, haven't they? So if you have something like that that's considered unusual, you call it out. If the company takes losses on available for sale securities all the time, then they don't have to put it down and call it out as unusual, right? It just really depends on the nature of things that the company's determined would constitute unusual for them, the type of things for them that would be unusual. And again, net income, we don't have to call out income from continuing operations if we don't have discontinued operations. Okay, let's take a look at a couple questions here. Under U.S. GAAP, a gain that is both unusual and infrequent should be reported as which of the following? Income from continuing operations net of tax? No, we had what? We had the tax out there separately, didn't we? Okay, we reported that unusual item. Net of tax following the discontinued operations? No, it was part of continuing operations, and it was before the tax, wasn't it? Okay, C, comprehensive income. That's way off the chart because comprehensive
income is a specific term used in companies' financial reporting from the company whole point of view. Do you want me to keep reading?
No. I swear they're listening to us. Okay. It was so weird. I mean, this is what old guys talk about. So me and my dad are sitting there, and my dad starts going on about ear hair. Okay. And then I kid you not, next thing I get an email, from some random site. So how to get rid of ear hair. I'm like, okay, they're listening. That's one thing Trump's right about. Okay, they are listening. Okay. How about income from continuing operations? Yes, it was called out as a separate item, but it constituted our income from continuing operations, didn't it? Okay. All right. Good. Oh, and I don't have to mark that because I think I took the next slide and showed it as income from continuing operations. Okay. I'm stealing a lot of this stuff from CPA these days, guys, because I see no reason why, if we're talking about something that I know is right in the wheelhouse of CPA questions, I'm just going to take you there to the CPA questions. Then I'll add some other ones maybe from the textbook if I see some good ones. Okay. Okay, good. Let's take a look at this one. In year one, hail damaged several of Torkin Company's vans. Hailstorms had frequently inflicted similar damages to Tocan's vans over the years. Tocan had saved money by not buying hail insurance and either paying for repairs or selling damaged vans and then replacing them. In year one, the damaged vans were sold for less than the carrying amount. How should the hail damage cost be reported in Tocan's year one financial statements? And you kind of start to look at that and you say, well, that's not sounding very unusual, is it? In fact, it's become so usual to them, they stop buying the insurance and say, okay, as part of doing business, we're going to lose this money, right? Okay? So you start to take a look, and I can tell you right out of the gate, expected hail damages, average hail damage is nonsense. There's no expected average. That's nonsense. Okay? So we're down to what? The actuals for the 2 years? Okay? And so is it the actual loss in continuing operations with separate disclosure, or the actual hail damage loss in continuing operations with no separate disclosure? Good. It's C. It's no separate disclosure. Excellent, guys. Because what? It's not weird. If it's not weird, then you don't have to do a separate disclosure on that. Okay? So I always want to click on the answer. So it's C. Okay. Now, a question like this, and I'm not going to get into CPA review mode, but it's a little bit tricky in that what I'll point out to my CPA students is this is like speaking to the child in you. Why not? With separate disclosure. Why not? It won't hurt anything, but you have to, and it won't hurt anything, and it's okay to do it if you want to, okay? But you don't have to. This said what? How would it be required under U.S. GAAP? Okay, so that's why you have to be very specific there and say that it's not with separate disclosure. Okay? All right, good. Let's take a look at this one. And the following items were among those that reported on lead company's income statement for the year blah, blah. The office space is used equally by Lee's sales and accounting departments. What amount of the above listed items should be classified as general and administrative expenses in Lee's multiple step income statement? How about legal fees? Are legal fees administrative? Yes, they are. So we got to pick up that 170. Good. How about rent for office space? Huh? Administrative expenses? Rent for office space? Okay. Now, what happens? It tells us that the office space is used equally by sales and accounting. So if it's used by sales, is it an administrative expense? No, it is a, well, no, these are all operating. Both sales and administrative are both considered operating, aren't they? Because they're part of our normal course of business. Okay, so they're both operating. The question that I'm asking you right now is selling an administrative expense. It is a selling expense. Okay, guys, go back. We had a couple of different categories. This is always good when I have to do this because my doctor told me my thumbs were getting fat. Okay, so good. We're all the way back to the beginning. You know what I told the doctor when he said my hair was getting thin? I said, good. Who wants fat hair? No, okay. All right, now you come over. And we looked at our classification of our expenses. I'll tell you one more, and then I got to get this other one out of my mind, and then I can go on. So the doctor said that I needed to lose weight. So I said, well, do you mind if I get a second opinion? And the doctor said, okay, you're ugly too. All right. Now, see, I never have to explain that one. Okay. So what happens? We sit here and we have what? We have administrative and selling expenses, right? Okay. And when we looked at this statement, selling expenses were things like sales, office salary, delivery expenses, depreciation on sales equipment or equipment being used for sales. And then when we got to what? Administrative, it was legal fees, it was depreciation of office equipment, etc. With me so far? Okay, remember I said, well, what if the same building is used? What do? Allocate those costs between the selling and the administrative? Okay, all right, so come back now. and look at this question. I hope I didn't go too far. One more. Right here? Okay, good. So if we have what? We have the rent for the office space, but they're telling us it's being used equally by the sales and the accounting department. Is sales administrative? It is a selling expense, right? So if the question asks me what is the administrative expenses, then I have to take that 240,000 and what? I guess divide it by 2 and it's 120,000 between the selling and the administrative. And so I get that 120 down here, and I guess the answer then better be 290, or I'm going to have to do some fancy footwork here. It's 290. Where'd my clicker go? Okay. Right? Okay, good. All right, let's talk about discontinued operations. Okay, now what happens? You guys have heard of GM, haven't you? General Motors. Are things that bad for the American car companies? No one knows what General Motors is. Okay, there's a company called General Motors. There's a company called Ford. Those are American car companies, and they come out with all kinds of different models of vehicle, right? So if we're talking about GM, you guys heard of Chevy, right? Chevy, the heart of America, whatever they call it, right? Chevy is a GM line, okay? You ever heard of a Buick? Okay. Yeah, you heard of one. Never been in one, but you've heard of one, right? Okay, Buick. Okay, all of these are GM vehicles. Now, you guys, before you were born, probably now, but definitely before you were born, they were popular. They used to have a car called an Oldsmobile. Okay, and Oldsmobile was sort of like the poor person's Cadillac. Okay, if you couldn't afford a Cadillac, but you were, going to move your way up someday to have a Cadillac, you'd go ahead, and in the meantime, you'd drive an Oldsmobile. Okay, now these were nice cars, pretty nice cars, not as nice as a Cadillac, which is also a GM product, by the way. Cadillac is GM, but you could work your way up. Now, at some point in time, people stopped buying Oldsmobile because nobody wanted to be old, right? Everybody wants a young mobile, okay? So they decided, GM looked at that and said, okay, we're losing money on our Oldsmobile division. We're going to discontinue it. They're going to get rid of it. Now, if you're picking up GM's financial statements and there's a major segment of the business that they've decided to get rid of, that would constitute what? A discontinued operation, and we would want them to separate that out from everything else on their financial report so users know that that's going away. Okay, so what we're going to talk about here is the process as to how we'll calculate what needs to show up in that discontinued operations section, and also what constitute items that belong there. Now we say there's no significant involvement in that component after the disposal transaction constitutes it being a discontinued operation. Okay, so you come over and let's just look at this little introduction, and I borrowed this from some stuff I have because I think it does a very good job at giving you some of the key elements of how we handle discontinued operations. So let's just read this together. Discontinued operations are reported separately from continuing operations in the income statement. We already saw that, didn't we? That section down there. And notice they tell us it's net of tax, and they're telling us net of tax here because we did what? We separated out the tax effects and then we kind of pulled it over into the column, adding it to our income from continuing operations, etc. Okay. Then what? Discontinued operations can include a component or a group of components of an entity or business or not-for-profit activities. Items reported within the discontinued operations can consist of, and there's really three things that we have to look at when we calculate what constitutes discontinued operations. One is an impairment loss. What happens? At the time that they're going to get rid of a particular segment, they have to, at that point, look at what it's being carried at on their books versus what they perceive to be the fair value, and that is part of your discontinued operations gain or loss, whatever it's going to end up being. Okay, so let's say, going back to the little Oldsmobile example, Olds assets equal book value. Book value of Olds assets equals $1 million. Meanwhile, GM does an analysis and finds out that the fair market value of Olds assets is only, and I'm making this number up, 600,000. At this point, we have impairment, don't we? And we have an impairment loss in this example of 400,000. So when Old sits there and it reports its gain or loss from discontinued operations, one of the elements of that gain or loss will be this impairment loss, right? Okay. Now, that's one element. The next element is the loss from actual operations. Now, notice the thing that I stole this from shows it as gain or loss, and I'm calling out just loss from actual operation. And I'm doing that because when does a company get rid of a segment that isn't having losses? Rarely, if ever. Rarely, if ever. Usually I'm getting rid of a segment because it's losing money, right? Okay, and you'll see that in the problems I'm going to be giving you, it's not like they were operating and they were having revenue all this, net income all this period. It was what? Net losses that constituted the decision to get rid of it, and that triggered the decision to get rid of it, and that's why we would call it loss from actual operations. And then we could ultimately have a gain or loss on disposal. That means that when they finally decide to get rid of this thing, if they sell it for a loss, then that's going to be part of the loss from operation. They sell it for a gain, then that will be part of the discontinued operations section. It just depends, okay, whether they sell it for a gain or they sell it for a loss, okay? Now, they tell us that all of these amounts are taken in the period in which they occur. Where you tend to run into some problems sometimes is you'll see exam questions, whatever, that will want you to take the loss that they're predicting is going to happen next year and take it in this year. You take all of these amounts when? In the period in which they occur. And if it's going to happen next year, you take it what? Next year. Okay, you don't take it all this year. You wait until that next year to take it. Okay. Now, I like this particular outline because the way that I remember the elements that constitute the discontinued operations is I give myself a little mnemonic, which is LID. Okay, which is what? The loss from operation, which is what? Right here? The loss from operation. We have what? The impairment loss. And then we have what? Disposal gain or loss. Okay? Good. And that helps me when I look at questions like this, and I have a pretty high batting average with these because I simply go through the question and see what elements they're calling out to me, and then I take them when? In the period in which they occur, and I have to remember to take them what? Net of tax, which is basically everything that's on this slide. Yes, sir.
What's the difference between the impairment loss and the loss on disposal? So
In,
if they were to sell so if they would determine it's only worth 600,000, and they turn around and sell it for 500,000, they would then have to take the additional 100,000.
that's right.
And then so it would be split up. So they couldn't take the
Yes, sir. It's exactly what you just said, and the takeaway there, so that we report in the period in which it occurs. So, yes, we're getting rid of this thing. We evaluate this asset, this division, whatever, for impairment, and that impairment is part of the elements of the discontinued operations segment, saying year one, where we took the 600,000, and then you said in year two we sell it for what? For 500,000. In year 2, when we sell it for 500,000, that additional 100,000 loss is now the loss of disposal, and it's part of the elements of the discontinued operations in year 2.
Okay. So it all could happen in 1 year, but that allows it to happen in 2 years.
If it all happens in 1 year, then the requirement would be we're only required to report out and disclose the loss on disposal. So we would have to disclose somewhere what our actual loss on disposal was, which 100,000, but we could show the entire total elements of lid. The total of the elements of lid is one line item in the discontinued operations section. It's going to get a little bit confusing because some of the examples I'm going to show you call out the loss from operation and the loss on disposal as separate items in the discontinued operations section. But the rule is, and I'll show you that in writing, that you only have to disclose the loss on disposal. And it can either be on the face of the financial statements or in the notes. Okay? Okay, so we've got these elements. Lid is a good way to look at these, right? Okay? Okay, so let's just go ahead then and let's take a look. Really? Okay, at how this would look on the section of the income statement, discontinued operations, and this is what I was just saying. Notice they say loss from operation of discontinued electronics division. That's the L in lid. Okay, then they have loss from disposal. The only item they'd actually have to disclose somewhere is this loss from disposal. Okay, now in this particular pictorial example, there was no impairment. Does there have to be? There does not have to be an impairment loss, okay? But if there was, the impairment loss would also, and if you're displaying it like this and you're going to talk about each element, I guess you'd have to call out the impairment loss. But the rule is that I could total up the loss from operation, the impairment loss, the loss on disposal, total those up, show it as one line item, net of tax on the income statement in the discontinued operations section, and then in the footnotes, the only requirement is that I disclose the actual loss on disposal. Okay, but you know, there's varying ways that this can be displayed here, and in this particular example, they chose to ignore the impairment and showed you separately the loss from operation versus the loss of disposal right on the face of the income statement. Okay. All right, good. Now, types of entities to be considered for discontinued operations, those that they have actually disposed of. If you actually got rid of it, obviously it's in the discontinued operations. Or what? Those that are classified as held for sale. So we haven't actually gotten rid of it yet, but our plan is to dispose of it, right? Okay, so we either actually got rid of it or we are going to. Okay, now what do we mean by held for sale? And I'm not going to go into a bunch of detail here. I just want you to put down here management is serious. Management is serious, and I don't mean serious radio. Management is serious in that what? They're going to get rid of it. Okay? You look at this list, management commits, components available for immediate sale, active program to locate a buyer. Does that sound like a serious management? Okay, so it's not like they're playing footsie with this thing. They're saying, hey, we're going to get rid of this division. We're ready to sell it, right? Okay, so either one of those, you either got rid of it or you plan to. Okay, now you come over and we know that discontinued operations, the items that would be included in there are the results of operations. We're calling that what? Loss from operation? Okay, gain or loss on disposal. That was going to be our what? Disposal gain or loss? Guys? And then this one is impairment. Does that spell lid? Kind of backwards. But it's the items that constitute lid. Loss from ops, impairment, and what? disposal, right? Okay, so there's just those elements again. Now, let's take a look and see what they tell us about an initial loss versus a subsequent loss, okay? And if we have an initial loss, we will go ahead and write down the asset and take the impairment loss. So let's just journalize that little example with GM and Oldsmobile. They would debit what? Impairment loss, whatever. What did we say it was? 400,000? Was it 400,000? And credit the Olds assets, whatever, for 100,000. I'm going to write that better. Debit impairment loss, 400,000. Credit Olds assets, 400,000. Is that a loss? Wrote down the assets, took the loss, right? Now, that 400,000 loss is going to be included in the discontinued operations segment, and I will either roll it up with any losses from operation, any disposal gain or loss for the period to report that. I can report that as one line item. However, I must disclose the disposal gain or loss. Okay? Okay, good. Now, I write it down at the time that I do my impairment evaluation. And then let's say that, I don't know, you guys like Beyonce or whatever? Okay? You guys like Beyonce? I know my dad does. Every time she comes on, hey, Beyonce's on the screen. Okay, so what happens? We sit there and we have a video with Beyonce. And it so happens that she's driving a baby blue Oldsmobile 98, like the one my dad had when I was a kid. I almost said when we were kids because my dad keeps now telling me that I'm his brother. Okay, you're my brother. Remember, Mom, this and that? And I'm like, no. That's when I have to break out the pictures. This is my mom. That was your wife. Oh, I remember her. She was really nice. Okay, so what happens? My mom's been gone for several years now. So anyway, so what happens? Oldsmobile 98, okay, is in this video. And all of a sudden, GM is thinking Oldsmobile is no good, and they're thinking it's no good, and they start getting all these calls. Hey, people want the Oldsmobile to come back, right? So they say, geez, we thought we had impairment on this thing. We were getting ready to get rid of it. There's no impairment at all. In fact, because of that video, Oldsmobile is not worth $1 million. It's worth $1.2 million. So let's write it up to $1.2 million. And the rule says what? If it increases in value, you can take a recovery, but not in excess of what? Previously recognized losses. So what would we have to do? We'd have to sit here and reverse this entry. So we would sit there and do what? Debit the assets, Olds assets, for what? 400,000? Because we're capped by that. And credit the impairment loss for 100,000. Did it come back? I mean, not 100,000, but what? 400,000? Did it come back? We can't write it up to 1.2. Okay, so the takeaway there is you can write it back up, but what? Not in excess of previously recognized losses. Okay. Now, yes, sir.
So what if they brought the car back, so they discontinued the model and they brought it back 10, 15 years later, like other companies are doing that? Does that matter?
That would not affect any of what we're talking about because we showed the discontinued operations in the period when we were thinking we were going to get rid of it, right? If somehow we revitalize that and bring it back, then that doesn't require any special disclosure other than maybe we want to put something in our footnotes. But we don't unreverse it. We don't put it back in some section on the income statement, revitalize discontinued operations and break that out. It's just as it's going away that we do something. If it comes back, fine. Okay. Okay, good. And then once you have included something in the discontinued operations, it's no longer depreciated. Makes sense, doesn't it? What's the definition of an asset?
Something used for the generation of revenue.
Well, future economic benefit, okay, right? And yeah, what you said would qualify, but the point is the future. And if we get rid of that thing, there is no more future economic benefit. If there's no more future economic benefit, there's nothing to depreciate, right? And so we stop depreciating that. Okay? Okay, good. So let's go ahead then and take a look. Oh, couple more things. Disclosure in the notes. Gain or loss recognized on the disposal must be shown either in the footnotes or on the face of the financial reports, right? One or the other.
But unless it's like the hail, you don't have to disclose that.
Unless it's like
Like
the
the expected loss, like when you
yeah, if it's the future, we take all of the amounts. So again, loss from operation, that's the L in lid, right? The impairment loss, that's the I in lid, and the what? Disposal gain or loss, that's the D. Okay, and those amounts constitute the gain or loss on discontinued operations, which is shown separately on the income statement after income from continuing operations net of tax. All of those amounts, L, I, and D, are taken in the period in which they occur, right? Not future periods. So yes, it would be the amount that's happening this period. Okay, but this D either has to show on the face or has to be what? Disclosed. You must say what that amount is. So you could add L, I, and D up, total it, show it on the face of the income statement net of tax, and then do what? Disclose what the loss on disposal was, even though we've seen some examples where they called them out separately. Okay? Okay, good. So let's take a look at this example. And they say the trial balance below, guys. I didn't put in the trial balance because I didn't think it helped us. And that trial balance makes things to me more confusing. So there is no trial balance below. Okay. But we have this all sports company, and they're going to get rid of the golf division because it's been losing money, okay, on a monthly basis. And I'm telling you right now that the amount that it's losing on a monthly basis is, damn it, $200,000 a month. Thank you, God. It's losing $200,000 a month. Thank you, Lord, for making that comeback. Okay, so it's been losing what? 200,000 a month. Okay, I'm just telling you that here. I'm just writing that in. Okay, now the board of directors decides on April 30th, year one, to dispose of the golf division. The carrying value of the golf division is what? 4 million, and its fair value less cost to sell is 2.2 million. Do we have impairment? We have impairment. We can calculate that right now. It's going to be 4 million minus what? Minus the 2,200,000. So we know we're going to have the I in lid, the impairment be what? 1,800,000? With me so far? Okay. After months of negotiation, the division's net assets are sold off on June 30th. We're in year two for 2 million. The golf division continues to lose in year two the 200,000 per month. It was right there. And then they tell us the income tax rate is what? 40% for year one and year two. And then they give us the income from continuing operations. Okay? And what they want us to do in this little exercise is sit here and show them what the discontinued, how this would all look on the income statement, right? So you go over and we have what? For year one, let's do year one first. You have what? Loss from operations, guys. And this is where I cut out the trial balance because it wasn't helping me to explain it to you. If it's 200,000 per month. How many months in a year? How many months in a year? There are 12 months in a year. That's how they get this loss of 2.4. I don't care about the elements that make up the loss. That's not the takeaway here. The point is, are we picking up the loss from operation, the impairment, and the disposal? And they told us they're losing from ops what? 200,000 per year. With me so far? Okay, now, very important point. You look over here and notice that the board of directors decided what? April 30th, year one, but we still took the full 12 months of the loss from operations from year one, didn't we? Remember our objective. Our objective is to show the users of the financial reports how this discontinued operations is down there. It's going away. We don't want to mix part of it up there with continuing operations for those first 5 months, whatever that be, 4 months, I guess. Because what? Then that's mixing the apples and the oranges. We want all of the discontinued operation activity to be down there in that section, don't we? So we take that 200,000 and we multiply that by the 12 months of the year. That's how they got this 2.4. Question on that? Okay, good. Then what? The loss from operation net of tax is 144,000 because we have to report that net of tax, don't we? And you're all cool with the 1 minus the 40% gives me the net of tax? 40% is the tax portion, 60% is the net of tax portion. Okay, so that gives me that 1,444,000 net ex tax. We already calculated the impairment, didn't we? Being 1.8 million, but we report everything what? Net of tax, don't we? And the impairment happened this year when we evaluated it. We thought it was worth 2.2 is what we thought it was worth when it was being carried at 4, right? That's how we got the impairment. And we take that net of tax. So we've got 1,080,000. And when we report our now income on our presentation of the income statement for year one, income from continuing operations, again, they just gave me that. That was 4,875,000. Income from continuing operations. And then I have my discontinued operations section, which shows the loss from operations. And this one chose to call out the impairment, didn't it? I could have totaled these two up and shown them as long as I show them what? Net of tax. And so net income is 2,355,000. Question? Okay, good. Let's look at year. What time do we get out of here? 3 minutes? Good, perfect. Okay. I'll only have you here for another 10 minutes. No, just kidding. Okay, so what happens? We come over and we go to year two. And in year two, the problem told us that they continued to lose the 200,000, didn't they? Okay, and then what? And then we had the loss on disposal, and the problem told me they ended up selling it for $2 million. Now, by then, we had already written it down to 2.2, didn't we? Right? So now we have an additional 200,000 loss, but this loss is not considered impairment now. It's considered what? Loss on disposal, isn't it? Okay, so we've got that extra 200,000. We take those net of tax, both the loss from operation and the disposal loss net of tax. They told us in the problem what the income from continuing operations was. We have our discontinued section. We have our net income.
Why did we multiply by 6 for year 2 and not by 12?
Because the fact pattern told us that they finally got rid of it on June 30th. So it only actually operated for 6 months. But thank you, that's a good question. It only actually operated for 6 months in year two. Okay? Question? Okay, good. That's pretty much the takeaway from discontinued operations. So do me a favor. Look at the slides, and you should be able to look at these discontinued operation questions right now that are coming up and go through those, and then we'll pick up the discussion here. We'll revisit these on Monday and work to finish Chapter 4 on Monday. Thank you. Okay, and I'll save these right now. Okay. All right, guys, have a good rest of the week. We'll see you next week. Please sign in if you did not.